Let's Talk Money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Now, asset allocation. You've often heard on this show itself, a lot of experts talk about how important it is to diversify our investments across different asset classes. So it's very important not to be squarely focused on any one, equities or gold or fixed income. This is where hybrid funds come in. And within the hybrid category, one category called the multi-asset allocation fund category, this has been garnering a lot of investor attention. In fact, the flows into this category have been going up, and we'll put up some of the data points that highlight that. At a time when mid-cap and small-cap funds, traditional equity funds, they've been getting lesser flows, and I'm talking about the latest numbers which came in from the industry body AMFI. At a time when regular equity funds have seen slight dwindling in flows, this category, the multi-asset allocation category, has been quite steady. As you can see out there, flows have been averaging anywhere between 5,000 to 6,000 crores on a monthly basis. So what's behind this trend? Is it sustainable? And is this fund category really an important one when it comes to us and our journey of wealth creation? That's what we're going to discuss with our Sivakumar, Head of Products and Corporate Strategy at Axis Mutual Fund. Sivakumar, thank you so much for joining in. It's a pleasure to have you, especially personally, now that you've taken the trip and you've come to our studio. So thank you so much.
Thank you for having me.
So, Sivakumar, this is an interesting topic because in your earlier avatar with Axis Mutual Fund, I mean, you're a veteran of the fixed income market anyway. Now you're overseeing a lot of other categories as well. So just walk us through what you've made of the investor psyche and shifting investment trends as we've gone through a year of low returns to almost no returns in the equity category.
Yeah, it's a good place to start. I think equities have had a great run, and I think equity mutual funds have continued to see inflows despite, as you rightly said, well, not poor performance, but I think consolidating performance, shall we say, for the past year or so. It's interesting that flows have continued to be at a steady clip, maybe slightly off from the peaks in terms of net inflows into that category. One of the interesting things that we've seen, especially over the last six years or so, post-COVID, is that investors have continued things like SIPs even when there is market volatility, which was not the case before. Every time the market would slip, you would see SIP cancellations and redemptions because people would, get frightful. This is the first cycle where we have seen kind of an equity culture, if I may say so, getting built, wherein people are staying invested and adding to their investments, even if the market returns, near-term market returns are not very strong. So I think that's the first and most important thing that you can see in terms of investor psyche, let's say over the last few years that we have observed.
Okay, so that's what's happened so far. And then, I mean, tying in with that, and we always talk about it when the mutual fund numbers come out and everybody's looking at the net equity number, and sometimes it's lower, and it's come down a lot from 40,000 crores per month to about 25,000 odd. But since I do this show and I look at personal finance, I see it as a sign of maturity, because simultaneously flows into hybrid funds and into this particular category, multi-asset category, they have started going up.
Yes.
So would you say that the lesson of asset allocation, that's finally getting learned? Is it getting learned well? And then, how do we look at some of these hybrid categories when it comes to asset allocation?
Yeah, it's a great question. And I think you're absolutely right. Multi-assets flows have remained strong through this entire cycle. Yeah. So one could argue, why is it if equities are done so well, why is it that people are investing in multi-asset and so on? I think a couple of key factors drive it. One is the relative stability. So when you look at long-term returns from multi-asset as a category versus equities as a category, returns are in the same ballpark, very close to each other. There are some really long periods of time when multi-asset has outperformed equity even, but at a much lower level of risk. And so the first thing is multi-asset as a category, I think, has proven itself. And this is not an India story. This is a global story. Across many markets, you have seen this data that multi-asset as a category has delivered similar return to equity, but at a much lower risk. The second thing that has happened, I think, is the tax change on fixed income funds, which happened a few years ago, and therefore the drop-off of fixed income allocation.
Yeah.
And people have chosen to invest in multi-asset and other hybrid categories as a proxy for debt, meaning to also get some debt exposure. I mean, that's one of the important drivers of flows into hybrid as a category as compared to traditional fixed income as a category. So I think that's something which again multi-asset as a category has managed to capture. That is to say, you get an exposure to fixed income and gold and equity at the same time, and you get a much more tax-advantaged way of playing those three assets together.
That's a very important graphic on our screen right now, and let's just explain that to our viewers. What you're seeing is basically how asset classes perform across different market cycles. And there is never a fixed rule. You can never wake up on the 1st of January and say, this is the asset class that's going to be the winner of the year. Because in this data, we've taken 3 different buckets, 5-year buckets. And you can see in the first bucket, immediately after the global financial crisis, which is 2008 to 2013, equities weren't doing that well. The Nifty 500 is actually down. The 10-year G-Sec yield, basically fixed income was a better performing asset class, 9%, and gold, because we were in a risk-off environment, gold did really well. Come to the next 5-year bucket, 14 to 19, again, the returns are varying. Equity and gold somewhere around the 7 to 8% handle, fixed income 9%. And then the real equity bull market actually took off just after COVID, which is about 17, 18% equity return, fixed income 6.5%, but gold did well even in this period. Now, who's to say, at least I cannot extrapolate the next 5 years and fill the 4th column of that table. But that's the thing. So, Sivakumar, let's address this. Asset allocation. For a lot of investors, they equate asset allocation to chasing kaun sa asset class acha karega. Now, gold did well, so let's put some in gold. And, maybe equities did really well, so let's go full hog on equities. How do we break out of that psyche?
Yeah. It's important that you break up asset allocation into 2 parts. What's called strategic asset allocation and tactical asset allocation. Strategic asset allocation has got everything to do with your return risk profile, and when you look at studies which say asset allocation explains all the returns of a portfolio, etc., those studies are based on strategic asset allocation, meaning how much you allocate to the different assets you own substantially explains the returns rather than individual stocks or bonds. It's really how much you allocate which matters a lot when it comes to long-term performance. That's the first part, right? Once you've agreed on a strategic asset allocation, let's say the classic portfolio 60-40, 60% equity, 40% fixed income. And these days, that's up for debate. Does that 60 become 61 or 65, or does it become 55? So how do you, at the margin, make that allocation decision on a year-on-year basis, or even on a 5-year cycle, as your data just showed, that for 5 years you can have different assets perform differently, right? That's where tactical asset allocation comes into play. So tactical asset allocation is about trying to play shorter-term cycles, from a few months to a few years, where you take a call on which asset class should be overweighting or underweighting. And I think that's where these multi-asset funds, which take asset allocation calls, come into play. See, as an asset manager, I cannot create every strategic asset allocation there is. Some investor may be close to 0% equity and some are 100% equity. Can I create products at every mix? Not possible. But we can create products which take these tactical calls.
That's a very important and very interesting thing you said. So first of all, it's okay to take tactical market-related calls with respect to asset allocation. It's not like against the cardinal rules of financial planning. There is the overall asset allocation that you should have depending on the nature of investor that you are. I mean, are you a risk-averse investor or etc. But there is a tactical element to it. And that's where these multi-asset funds fit in.
Correct. And you can do this by having multi-asset funds which buy directly into stocks and bonds and gold, etc. But you can also do through a fund of funds route wherein you're investing across, let's say, equity mutual funds, debt mutual funds, gold ETFs, and so on and so forth. So I think the way to play this is multiple ways. If you're, for example, owning a multi-asset fund in the traditional way, which owns stocks and bonds directly, then it's more of a bottom-up picking of stocks, and with, of course, macro and other overlay. But you can also do a fund of funds approach where you're doing a lot of top-down, right? Trying to figure out top-down, what's the right allocation to have, and then trying to find which funds, which strategies. Do you want to go into thematic or sector funds? Do you want to buy flagship equity funds? Do you want to similarly do on the credit side or a duration side, etc.? So that becomes an interesting way to have 2 or more approaches to tactical asset allocation.
Okay, so that's lesson number 1 that we've learned, that multi-asset funds could be an interesting way of blending more asset classes in a smart way into your portfolio, because we may not know all markets. We do not know which asset class could perform which way. There are, fund managers who have better visibility in all this and are more equipped at taking those calls. Now, Sivakumar, again, lesson number 2 is just understanding what these multi-asset funds look like, what is their structure. So I believe they have to invest in a minimum of 3 asset classes, right?
Correct.
And is there a minimum threshold, holdings? What is their overall, and what is the regulatory framework?
The regulatory framework is, yes, minimum 3, and the minimum within. So for example, if you have equities, that has to be minimum 10%. If you have commodities, that has to be minimum 10%. So from a regulatory perspective, to qualify as a multi-asset fund, you need to have minimum 3 asset classes, and each of them have to be meaningful. You
At
cannot
least
have
10%
1 or 2% in an asset class and call that a multi-asset, right? So the idea is to have some meaningful allocation, and the regulatory minimum is 10%. So most of the funds in the industry have gone with equity, fixed income, and gold, or commodities in general, gold, silver, and other commodities, as a way to satisfy this need. And I think that's probably the right approach. You could add global stocks, for example, as another asset class in this. I don't think anyone's really doing it. And in the current situation, of course,
there are limits on the global exposure that you can take.
And that creates its own challenges. So therefore, today, that may or may not be the right way to do it, but at least you can have minimum of 3, minimum of 10% in each. Whether you do that through direct investments or through a mutual fund, it's fine. But the idea is to have at least 10%. That's something meaningful. The second consideration that comes into play here is, of course, taxation. As we discussed, on debt, taxation is quite punitive in the sense you get marginal tax. Whereas if you do a fund of funds, or if you do a 65% plus equity or a 35% plus non-fixed income, then you get long-term capital gains tax, which is way more beneficial to investors. So that's the other consideration that fund managers have. That in theory, you could have a multi-asset fund which is 80% debt and 10% equity and gold, but it doesn't make sense because it's far more tax inefficient. So you would want to be equity heavy, or you would want to be at least reasonably balanced.
But that's also an interesting dilemma, perhaps, that it raises in itself, taxation.
Yes.
Because like you explained, that if first of all, there is no standard taxation rule for multi-asset funds. Please be very clear and make sure you keep asking your advisors about this, because the way a multi-asset fund will get taxed will depend on the amount of equity it's holding. If it is holding more than 65% of its assets in equity, only then does it get the advantage of equity taxation, which means that after 1 year, you pay long-term capital gains tax at 12.5%. So that's the most favorable taxation from our perspective, from the investor perspective. But that also raises a question, and just tell us what you see across industry. In order to be tax effective, if most multi-asset funds are anyway loading up on 65% equity, then are they really being true to their mandate, which is offering a great balanced multi-asset portfolio?
Yeah, so there are two choices. One is about 65% equity to qualify for the 1 year long-term capital gains tax. The other is to be above 35% in non-debt. So up to 65% in debt, but not crossing that 65 threshold, which means you get long-term capital gains after 2 years, but the same rate. So, which essentially, 2 years is nothing for a asset allocation investor, right? So I think for investors who have beyond 2 years, you do have a greater choice of these multi-asset type of products, because you can do pure equity or equity biased, or you can have a more balanced portfolio. So both options are on the table. I think we take too short a view sometimes, and we believe that 1 year is important, but 1 year is not important from your investment life cycle, right? You are investing maybe for 5 years, 10 years or more, and so it makes sense to look at these funds from a longer term perspective rather than from a 1 year perspective.
Okay, all right. So now we've learned the basics of this category, the multi-asset allocation category. We'll come back, talk about reasonable return expectations from this category, and also figure out what are the kind of funds. How do you choose the right fund? How do you blend it with the rest of your portfolio? That and more after the break.
Let's talk money.
Welcome back. You're with us on Let's Talk Money, and this week we are discussing multi-asset allocation funds, why they are important, and just how they can complement your portfolio for better, more balanced, and more sustainable returns. And of course, we have with us our Sivakumar of Axis Mutual Fund for this conversation. So Sivakumar, the most interesting part, returns, right? So experts like yourselves tell us that from equity, reasonable expectations would be like 12 to 14% compounding returns over long periods of time. In good years, it could touch 15%. Now, if you add more masala to the mix, because you have multi-assets now in this fund category, then what's the return expectation?
I would hope that this category can deliver returns which are broadly similar to equities, but a lower risk rate. So what that means is that, why that happens is because of the two things. One, these funds tend to be less volatile, therefore they have less drawdowns. If you think mathematically, right, if a fund falls from 100 to 90, there's a 10% fall. To get back to 100, you need 11% gain, because 90 plus 10% is only 99. So it's not enough to get back to where it was. So the drawdowns are never fun. If you go from 100 to 75, which is a 25% fall, you need a 33% return to go back to previous peak, right? So volatility containment is the first way that these funds manage to keep return. The second thing is being able to take calls. As you pointed out earlier, this cycle gold has, equities have done really well, but gold has done even better. So how do you kind of have a process around picking which asset class to buy, and therefore be able to deliver some alpha through that. And because of this, we expect returns in this to compete with equities. I think in a bull market, it's tough to beat an equity fund, but over a cycle, to be able to compete with equities in terms of performance at a lower rate of risk is what we would expect to do.
Okay.
And as I mentioned before, right, one of the interesting things is this is across the world. It's not an India-specific story. If you look at asset allocation, everywhere in the world, you've seen similar to equity returns at a lower rate of risk. So it's globally valid statement that returns for multi-asset will be similar to equities.
Okay, that's quite phenomenal, right? Yeah. Equity-like returns with lesser volatility. Now, who wouldn't want that? Which also brings me to the question, then how do you pick the right MAF, as they're called? If you hear that acronym MAF, you know we're talking about multi-asset allocation funds. How do you pick the one that's right for you? Because all of them would be running different strategies. Someone would have, more gold, more equity, less equity. So how do you decide?
I think, first of all, align to the asset allocation choice. I mean, as we discussed, some may have more than 65% equity, and therefore bias will be towards higher volatility or higher equity allocation, and others would have a more balanced mix. So take that. Go for the right strategy. I mean, are you doing a pure equity debt approach, or are you doing fund of funds? Because again, that makes a difference to the return profile and the risk profile of that. So I think choices should be made more on the underlying asset allocation or the ranges which the fund managers are guiding, and the investment strategy. Is it a top-down fund of funds approach? Is it a bottom-up stock picking approach? And that would be the primary driving force. And of course, track record does matter. So you'll have to look at whether in the fund house is delivering on that, whether it is through returns or whether it is through actual positioning. I mean, if you are claiming to be an active asset allocator but you run passive, that's not helpful. Similarly, if you expect to be passive but then you're seeing wide ranges, again, that's not helpful. So what does it align with your view? As an investor, does the fund strategy align with my view? And that's going to be the first port of call.
Okay, fair enough. So plenty to think about as you make your final choices. Now tell us, at Axis Mutual Fund, what's the house call on different asset classes? I mean, what are you guys tactically most bullish on as we get into 2026?
The interesting thing is obviously there's been a change in the market outlook over the last year or so. I mean, the most important thing, and I come from a fixed income background, so I'll start there, which is to say that, we've had an RBI which is extraordinarily accommodative, and yet bond yields have risen for the best part of the last several months, which usually is a signal that the economic cycle is turning up. Right? So expectations of inflation are slowly going up, and eventually with a 1 year, 2 year forward view, the market's slowly expecting rates also to start moving up. That's what this suggests to me, that why is the market not reacting to today's movement of the RBI? Now, if the economic cycle is turning up, then obviously that's going to mean equities are
positive for equities.
Positive for equities. So really speaking, even though we've had relatively soft equity performance and relatively good bond performance over the last couple of years, I think the script is likely to flip, and bonds are likely to be middling. And I think if the growth cycle comes back, then equities will outperform. The other thing is how India has performed relative to the world. We have underperformed, and underperformed massively. So the valuation, or shall we say the valuation premium of India to Asia or to the world has massively corrected.
Reduced,
right? And we are now reasonably valued compared to the rest of the world. And if there is a change in the global investor psyche to move away from tech and AI, etc., to going back to fundamentals, then I think India will be a big beneficiary. As an allocation, so much of the money which has gone out of India has gone into tech stocks or China or any of these themes. And if that theme changes, suddenly you will see a big beneficiary. So I think we are a lot more positive on equities. I think fixed income will be more middling. I think gold really is about playing shorter term cycles, figure out gold and silver. Relative performance between gold and silver has been an important theme for us, rather than just absolute call on where gold will go. I think we'll continue to play that.
So still bullish on both gold and silver?
No, like I said, it's not about bullish on gold versus bullish on silver. I think for us, the way we've made money is actually weights between the two, meaning at what point of time do you want to be overweight silver, overweight gold. Keep a reasonable allocation, but play through relative valuations, relative prices, let me say.
All right, so that gives us sort of a broad framework that you at Axis Mutual Fund, your teams are deploying to take those investment calls. Finally, back to multi-asset allocation funds. In an overall portfolio that'll have equity, large cap, mid cap, small cap, it'll have some other maybe these dynamic asset allocation funds as well, because they also move across equity and debt. How much should we give to MAFs?
There is no, this now, we moved it from a realm of asset management into personal finance. And I think it's a great place, it's a great question from that perspective, because it affects all of us individually, right? at a minimum, it should be like, 10-20% of your portfolio should be in this mid space, meaning it's not pure equity, pure any one asset class. Then you need to have the tactical ability to switch. But then it changes according to every investor. So there is no one way of looking at it. But have a reasonable allocation, because these small cycles, 1 to 3 year cycles, do make a difference when it comes to performance. And as a normal investor, I mean, I work in an asset management company, and yet I myself take a reasonably passive view to my own investments, right? Because I'm not out there trying to
Doing
make
it on a daily
changes,
basis,
on a daily
yeah,
basis.
yeah,
So why not let an asset management company or let a fund manager pick that call, and you make your broader decisions as an investor. And that's why I feel that have a small but meaningful allocation to this hybrid category.
Okay, all right, Sivakumar, thank you very much. Great insights there, and plenty of food for thought, as well as perhaps investors look at getting more involved with their portfolio, adding more hybrids, and adding more than equity in terms of asset classes to their portfolio as well. Thank you so much for this conversation. Well, thank you, viewers, for being with us. Keep sending us your feedback, comments, queries, and of course, we'll see you again next week with another theme.
Let's talk money.